In a recent video, I shared a story of a couple that had talked to me at the beginning of their retirement. And at the time, they felt very good about the taxes they were paying. They were in some of the lowest tax years of their life. They did want to look ahead and think ahead, and yet they didn't put a plan in place. And now, many years later, they're about to start required minimum distributions, and they're beginning to realize they let some years go to waste. Now, that story resonated with a lot of people because it's something that I hear more often than I wish I did. People retire, their taxes go down, they feel like they've got a break, and yet what they don't understand is that they've actually got an opportunity to improve their lifetime taxes over their retirement years. And so I want to talk about that today. I want to talk about the gap years between when you retire and you have to start taking required minimum distribution. Those years are some of the lowest tax years you'll ever have. What can you do to make the most of them so that you improve your situation over retirement? Don't just let them go to waste. The gap year has a point in time that it comes to an end because you have to start taking required minimum distributions on the government schedule when they say that you have to start. So you want to think about what can you do during those gap years. Now, there are three main strategies that rise to the top. One is to do Roth conversions, get money moved out of the IRA and into a Roth IRA where it doesn't have required minimum distributions and it's not going to be taxed in the future. Another is to harvest capital gains. You may have a lot of deferred capital gains and you could harvest those at basically no cost during those gap years. And the last thing is minimizing your income before you can switch to Medicare and keeping that health insurance cost at a minimum by qualifying for a premium tax credit. These three different strategies work for different people, but they all compete for the same tax bracket room. And so you want to think through which one is going to be the best one for you, what's going to give you the biggest bang for your buck, so to speak, improve your situation the most, what should you use, and in which years should you use it. And so I want to go through some examples in this video of clients that use different strategies, what they did and why they did it, and give you some insights into how to determine what would be best for you. So let's talk first about Roth conversions. I had a couple that came in to my office who had saved very well, millions and millions of dollars, all in their 401k. They had done everything that they were told to do, save as much as they could, defer the taxes to later, and yet here they were with all of this money in their 401k, and the only way to get it out was to pull it out as a distribution and pay ordinary income tax on it. And if they didn't take any action during the gap years, if they lived off of other income, then by the time that they hit required minimum distribution age, that was going to be a very big number. It was going to push them into a very high tax bracket and a very high IRMAA surcharge. So we looked at how to strategically convert some of their IRA each and every year, get it shifted into their Roth IRA. Now they have to pay tax when they're moving it over, but they're settling up on the tax on that portion at a known tax cost and in a lower tax bracket because we're choosing how much to convert. And then once it's shifted into the Roth IRA, there's no tax on those dollars in the future. Now this worked very well for them because of the amount of money that they had in those tax deferred accounts. By shifting into the Roth, we were not only getting some of the money out at a lower tax bracket than they would have in the future, we were also locking in that tax cost at a known tax rate, and we're not really 100% certain what the future tax rate is going to be. And we were moving all of the growth on those dollars into that tax-free bucket. So all the way around, this improved their situation, not just for themselves, but also for their heirs. Now, this strategy, looking at strategic Roth conversions, is one that fits somebody that has a large amount of their retirement portfolio saved in the tax deferred, the 401k, an IRA. money that has never had any tax paid on it that has to come out with taxes. But not all people have a large percentage of their money in tax deferred accounts. I had another couple who retired and they had a large amount in taxable accounts. They had received restricted stock units and big bonuses and deferred comp. And as they received that money, they put it back into investments. They bought stocks and exchange traded funds, and they let those things defer until retirement. So when they retired, they had a very large embedded capital gain. That means if they wanted to use any of those funds, they were going to have to sell them and pay the tax on the gain. But during the gap years, they were able to sell some of the shares and step up the basis with no tax on the capital gain because they qualified for the 0% capital gains rate. If you've got a lot more of your money in the taxable account and you've never paid tax on it, you can begin to think about how to shift the assets that you have, step up the basis on some of those, and begin to shift them into the things that are going to fit for retirement. Now, both of those strategies use up the same tax room. And as you fill up those brackets, it pushes the income into the next highest level. But some people need to keep their income lower in order to minimize the cost of healthcare, because healthcare can be so very expensive if you are no longer working and you're not yet able to be on Medicare. If your income is below a certain level, then under current law, you can get a premium tax credit that helps reduce the cost of that healthcare. And that can be a reason to minimize your income. One of my clients recently retired, and the cost of their healthcare would be extremely expensive. And yet, if we minimize their income, strategically use their IRA and their taxable account below the threshold, and then shift to using their Roth IRA above the threshold, then they're getting a premium tax credit that's pretty hefty. They're getting about $1,000 a month. And so that's about $12,000 a year that is being applied as a tax credit against their healthcare premium. Now, where this would fit in your situation is if you're below Medicare age and you want to keep your income at a level where you get the premium tax credit, you're going to have to strategically think about what are those sources of income, where are they coming from, how can you combine them to keep your income at the lowest level possible in order to qualify for the premium tax credit. And then when you hit age 65 and you shift over to Medicare, then you can begin to look at the other strategies from that point up until you have to start taking required minimum distributions. You don't have to use just one strategy. You can combine the strategies over your gap year period in order to achieve the best outcome for yourself. The right strategy for you is going to depend on where your money is located. Do you have a large balance in tax deferred? Then the Roth strategy could be the best one for you. Do you have more of a balance and you're wanting to minimize your premium? Then minimizing your income could be the right strategy for you. Do you have a lot of deferred capital gains because you saved very well over the years in taxable accounts? Then using capital gains harvesting could be the right strategy for you. Thinking about the gap years strategically, not letting them go to waste, is going to put you in the best position over your whole retirement period. And so I want to encourage you to get a plan. If you are approaching retirement, begin to think about where your money is located. If you are at retirement and you're going to be in those gap years, think about how you're going to use them to your advantage. And if you're already at required minimum distribution age, then think about what you can do to make a little bit of difference each and every year. You don't have to throw up your hands and say, well, I'm already at required minimum distribution age. You can still make a difference in your long-term plan and in what's left to your heirs, but you've got to strategically focus on it each and every year. So I encourage you, work with a financial planner who is a forward-thinking, tax planning, financial planner, somebody that focuses on it and is an expert in this area. And if you don't have somebody that is a financial planner that focuses on tax planning and you'd like to know how I work with people, then I encourage you to check out my website, www.bestpathadvisors.com. And if we're already working together, then you know that this is something that I am so excited about to look at each and every year. How can we improve your tax situation? I love to do that, and I look forward to talking with you about it as we approach all of the tax planning for the end of the year. And in closing, I hope you're all on your best path in your retirement.